Thanks for clicking! The Canadian government has to allow real estate prices to fall in order to make housing more affordable. This according to a recent analysis from Mike Moffatt of the Missing Middle Institute.
Yeah, no Sherlock!
Well, yeah, and while the link between affordability and price shouldn't be too much of an intellectual stretch, the day before the Bloomberg article was released, the Financial Post came out with an article positing just that housing prices and affordability are not mutually exclusive. The Canadians want a government that protects house prices. And this falls in line with what we recently heard from our new housing minister, that prices don't have to fall for housing to be affordable. And yet, despite the article from the Financial Post, despite what we're hearing from the powers that be, according to Mike Moffatt at least, if house prices don't fall, it could take between 18 and 25 years before housing affordability returns to 2005 levels. With that said, Robertson is the new housing minister, and the Financial Post, at least according to the Financial Post, is a financial newspaper, so maybe their arguments are worthy of consideration. So what I want to do today is go over Moffatt's argument that it could take 18 to 25 years to restore housing affordability if prices don't fall, take a look at the rebuttal in the Financial Post, and then discuss some implications. As we'll see today, interest rates can and do play a part in housing affordability, and we are expecting the Bank of Canada to make its next interest rate announcement in just 2 weeks' time, with a press conference held thereafter. We'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into this article. Onto the article. While some, including Gregor Robertson, our new housing minister, say that house prices don't have to fall to restore affordability, others, such as Mike Moffatt, take a much more plain view, noting that it's simply not possible to restore broad-based affordability to the middle class without prices going down. And that is an unfortunate answer for the middle class, as according to RBC at least, housing affordability has plummeted over the past 25 years. Moffatt ran the numbers to see how long it would take for housing affordability to return to 2005 levels, or right about here, and found that it would take about 18 years of the average price staying the same, or about 25 years in Ontario and BC, to restore to those 2005 levels. So if the average price never moved up again and we just waited for incomes to catch up at the normal rate, it would take about 18 years for affordability to return to those 2005 levels. But let's just double check these numbers ourselves, do some actual investigation just to make sure that it all tracks. Back in 2005, the average price of a home was $231K and the median income was $36,800, which will convert back from 2023 dollars that's listed on Stats Canada, and we get a median income of $25,000 back in 2005, meaning the average price was roughly 10 times the income. Fast forward to today, and the average price is now sitting at $680K, and the median income is $45,400, or about $47,500 in 2025 dollars, meaning the average price of a home is about 14 times the median income.
This is good for all of us.
Well, yeah, just wait a minute. The Financial Post is going to tell us how great this situation is for everyone. So let's see if that 18-year calculation tracks, given that for the past 20 or so years, the median income has grown at an average of 1.18% per year. That median income will reach $68,000 in 2046, or about 21 years from now, right in between that 18 to 25 year estimation on the part of Moffatt. So, Moffatt is in fact correct. If prices don't fall, affordability won't return to 2005 levels for the next 20 years, which is essentially what the new housing minister said is the government's plan.
Prices need to go down. No, I think that we need to deliver more supply, make sure the market is stable. It's a huge part of our economy.
Yeah, so if you don't want prices to go down, you just want more supply. Essentially, you're just trying to prevent prices from shooting up. You're hoping that prices are going to stay the same and that incomes will have a chance to move up.
I got your back, bro. Trust me.
Now, let's consult our financial wizards in the Financial Post to see why that's such a good thing. Those same wizards, like the exact same authors, who warned back in July of 2024 that you shouldn't wait for interest rates to drop to jump into the market, as you could end up seeing higher prices. Had you have listened to these wizards at that time and bought that benchmark price home in Toronto, you are now down $90,000.
It was fun while it lasted.
Onto the article. First off, the authors note that were we to see a major price correction, the economic and social consequences would be severe, depleting the savings of vulnerable households and pushing aspiring homeowners farther from their goals. So the argument is that if we see a major price correction, things are going to be so bad in the economy that it's going to be even more difficult for the average home buyer to buy a home.
You are nothing without me.
Except that if we look back in the post-GFC crash, when the U.S. housing market crash saw a major price correction, housing affordability actually got much better, with 2012 being the best year for affordability since the 1980s. Further, if we look at the data, that 2012 year, that was the best year for affordability since the 1980s, home sales were actually on the rise. So it didn't really seem to stop first-time homebuyers from entering into the market.
Yes, but at what cost?
So, a major price correction, worse for home buyers? Not necessarily. That's not what the data says. But, says the Financial Post, if prices were to fall, it would be worse for home buyers when they went to actually buy a home, as they would be buying a depreciating asset, meaning it could be more difficult to secure financing. Which, yeah, sure, maybe it could be a bit more difficult, but that's why you have financing conditions in the first place. Financing conditions which you don't waive until the value has been accepted by your lender. It's a very weak argument. Further, I can tell you, talk to home buyers who purchased back in 2021 when prices were going to the moon and bidding wars were the name of the game, and our realtors were the most impressive individuals on the face of the earth, and then talk to home buyers now. They'll tell you that they much prefer current processes where they can have housing inspections, finance conditions, appraisal conditions, etc., than the rushed process when they overpaid back in 2021. So, the data and the processes just don't match the narrative being put forward in the Financial Post.
Why would I start now?
Now, the authors of this propaganda-infused the authors of this totally useful piece of academic research, if you didn't finish high school, argue that the method used by Moffatt, indicating it could take decades for affordability to return, comparing prices to income, is of little utility today, since affordability isn't just a bivariate relationship between price and income, which is just a fancy way of saying interest rates can act as an intervening variable, can make houses more or less affordable regardless of income. And to support this, they point to the 1980s when price to income was much lower, but affordability was even worse, which is just sneaky. They're pointing to an extreme case, high rates in the 1980s, and saying that because of that, Moffatt's methodology, looking back to 2005, when interest rates were like exactly where they are right now, to say that using a price to income comparison doesn't work. I remember one of my profs pointing to the lame academics that use straw man arguments to push their nonsense, but he never mentioned the Financial Post would pay you for it. So the Financial Post makes the argument that were home prices to dive, that would actually be bad for home buyers, despite all of the evidence, intuitive and real, to the contrary. With that said, the argument is in fact correct about what declining house prices would do to retirees, those who planned on their home values remaining constant for retirement. And that's difficult to argue with. Say you bought back in 2015, you bought that average price home for $451,000, meaning if prices were to drop to that 05 level to 10 times the median income, house prices would have to drop to $450,000. Meaning you just lost 10 years of growth. And as to whether or not that's okay, I'm going to leave that one to everyone else, as it's a political question, as where you sit is where you stand.
You us! No, you you!
With that said, I will note that Ottawa letting the market beat the market, let the market do what it does, prices up or down is one thing, that's not really the government intervening, but if the argument is being made that Ottawa should intervene to prop up the housing market, do what the Financial Post advises, and fulfill its responsibility to maintain stability in housing prices, now you're inviting the government into your home.
King of England could just walk in here anytime he wants.
Well, maybe not that far, but if you're asking the government to move into the real estate market, asking government to bail out the industry, maintain and prop up prices, don't be surprised if the government wants something in return.
I'll call upon you to do a service for me.
Now, whether or not the government is going to bail out the industry, bail out the real estate market that does appear to be getting worse with no end in sight, remains to be seen, though it wouldn't surprise me. But the government and the powers that be should be honest with the population that if prices do remain the same, it's going to be a very, very long time before affordability is restored for the middle class. But, like we said, politics is very, very much about who gets what and how much. In order for affordability to be restored, someone's going to have to pay. In order for it to be maintained, current levels of affordability to be maintained, someone's going to have to pay. Right now, it's the middle class. Whether or not the government will be bailing out the real estate industry as this all continues to worsen remains to be seen, but we will obviously continue to track how this all materializes on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.